Hi and Assalamualaikum to our lecturer Sir Arif bin Abdul Rahman and all viewers. My name is Nur Syahada Mita Abdul Samad and I would like to share about fundamental analysis. Before we continue our lesson, let us start with Kitab Al-Fatihah.
Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alamin. Ar-Rahmanir-Rahim. Maliki Yawmiddin. Iyyaka na'budu wa iyyaka nasta'in. Ihdina as-siratal mustaqim. صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين.
Amin Ya Rabbal Alamin. Now let us start with our lesson, fundamental analysis. Assume that we are investor and we would like to invest in an ordinary shares of a company. Before we decide which company that we would like to invest in and how much share that we would like to buy, we have to do an analysis called a security analysis. This security analysis can be divided into two. There is technical analysis and fundamental analysis. Technical analysis is a process where the trend of stock price are used in order to determine the worth value and potential of the company. It is used to determine the right time to buy or sell the share. It will mainly use chart. If you notice in the section of stock report in newspaper like Star or NSTP, they provide the graph for opening and closing price of a share for a certain period of time. That is also considered as chart for technical analysis. And secondly is the fundamental analysis. Fundamental analysis is a form of analysis that use all of the information about the company and the outside factors that might affect the price of the stock. It is used to determine what, how much, and when to buy. This fundamental analysis can be divided into three steps. Firstly is economic analysis, secondly is industry analysis, and thirdly is company analysis. Firstly, we go to economic analysis. Economic analysis states that the overall condition of the economy will affect the price of stock. The assumption in this analysis is that the price of the share will increase in a good economic environment and will decrease in a bad economic environment. Economic environment can be influenced by, firstly, is government fiscal policy. Government fiscal policy is something that government impose on the company, like for example the tax. When the tax of the country increase, then the company will likely have to pay more tax, and this will decrease the earning after tax of the company. Secondly is inflation. Thirdly is the change in currency rate. And fourthly is a purchasing power. The people in the country with a good economic environment will likely have a greater purchasing power. This economic analysis can be measured by, firstly is gross domestic product and secondly is industry product. Gross domestic product is an income of the country. The more the income of the country, the better the economic environment of that country. Therefore, before the investor made the conclusion about which company that they would like to buy, they will have to choose the company and industry that will gain benefit from the changes in economic environment. Secondly is industry analysis. Industry analysis is a process of evaluate the industry to be invested in. Investors should compare the performance of industry and choose the one with greater potential. Industry is a group of companies that produce the same product or service. Among the issues that has to be evaluated before choosing an industry are, firstly is nature of industry. We have to determine whether the company is a consumer producing company or a company that render a service. And secondly is the level of competitiveness. We need to know whether the competition in that industry is stiff or how many players are available in that industry. Thirdly is a role of government. We need to identify whether the industry is highly regulated by government or not, like a banking industry. And fourthly is other issues that might affect the industry, like for example employment issues. This industry analysis, they are divided into 4 cycles, which is firstly is introduction, secondly is growth, thirdly is maturity, and fourth is decline. In introduction stage, it is where the industry is relatively new and it is still not receiving attention of the investor and consumer. And for the second stage is the growth stage. It is where the company is in the expansion stage and is start to gain rapid attention. It is where the best stage where the investor would like to go for. Thirdly is maturity. It is where the company has a more predictable performance and the growth is slower. And lastly is decline, is the final stage where the industry is not performing well. And lastly, for the fundamental analysis is the company analysis. Company analysis is the analysis made on the company by comparing the potential of several companies in a chosen industry. It can be measured through, firstly, is a SWOT analysis. SWOT analysis will show the strength, weakness, opportunity, and threat that will be faced by the company. It is to determine the strength and weaknesses of the company. Secondly is the vision and mission of company. It is to determine the real direction of the company, and this vision and mission can be get from the prospectus. And thirdly is the financial ratios. Among the major financial ratios are, firstly, liquidity ratios. It is used to show the ability of company to transform the non-fluid assets to money. Secondly is activity ratios. It is the effectiveness of the company in conducting the operation. Thirdly is leverage ratio. It is level of debt of the company. Fourthly is profitability ratios. It is the profit that is gained by the company. And lastly is common stock ratio. It is the value of per share basis. We go to liquidity ratio. Liquidity ratio can be divided into two. Firstly is current ratio and net working capital. Current ratio indicate how many cash or money in bank that is available to cover short-term liability. The formula is that current asset divided by current liability. Secondly is net working capital. It shows how much working capital or equity available for expenses and growth of the company. The formula is current asset minus by current liability. Secondly is activity ratio. It can be divided into 3, which is account receivable turnover, inventory turnover, and total asset turnover. Account receivable turnover is how fast company collect the account receivable. The formula is annual sales divided by account receivable. The faster that the company is able to recover the account receivable, it is better for the company. And secondly is inventory turnover. It is how fast companies sell the inventory. The formula is annual sales divided by inventory. The faster the company is able to sell the inventory, the better it is for the company. And thirdly is total asset turnover. It is how efficient the company use asset to gain sale. The formula is annual sales divided by total asset. The less total asset are used to generate sales, the better it is for the company. Next is the leverage ratio. It can be divided into 2, which is a debt equity ratio and time interest earned. Debt equity ratios shows weight of debt compared to share issuance in the supporting the business. The formula is long-term debt divided by equity. The more equity used, the better it is. And secondly is time interest earned. It is ability of company to make the fixed interest payment. The formula is earning before interest and tax divided by interest expenses. Next is profitability ratio. It can be divided into 3, Firstly is net profit margin. It shows the profit earned from business and other activities. The formula is profit after tax divided by total revenue. Secondly is return on asset. It is the profit gain in every asset capitalized. The formula is profit after tax divided by total asset. The less asset used, the better it is. And lastly is return on equity. It is a profit earned in every ringgit invested by shareholder. The formula is profit after tax divided by total equity. And the last class of ratios is common stock. It can be divided into 6. Firstly is price to equity ratio. It used to indicate the market to real value of the company. The formula is market price of share divided by earning per share. Secondly is price earning growth ratio. It is used to compare the price earning ratio with growth of earning. The formula is price earning ratio divided by growth of earning. Next is dividend per share. It is a value of dividend received for every 1 unit of share. The formula is dividend attributable to ordinary shareholder divided by number of ordinary share. The greater the number of dividend per share, the better it is for the shareholder. The fourth one is the payout ratio. It shows how much profit given as the dividend. The formula is dividend per shares divided by earning per shares. The greater the dividend per shares given to the shareholder, the better it is for the shareholder. Next one is the book value per share. It is the difference of asset and liability in every share. The formula is equity divided by number of ordinary share. And the last one is price to book ratio. It is used to compare market price of share to book value to see appreciation or depreciation of stock price. The formula is market price of ordinary share divided by book value per share. That's all for me. Thank you.
Okay, now I will proceed to the question and answer. First of all, I would like to thanks to Shuhada for the explanation about the fundamental analysis. Okay, now we go through the question first. Okay, right here, uh, we will- we are provided with the balance sheet and income statement for the year ended 30 June 2010. Okay. Then the question asks us to calculate the following ratio, which is current ratio, quick ratio, inventory turnover ratio, average collection period, fixed asset turnover, total asset turnover, debt to equity, debt ratio, debt earned interest, earning per shares, dividend per shares, dividend payout ratio, retained earning ratio, net profit margins, return on asset, return on equity. Okay, for the earning per share, dividend payout ratio, and return earning ratio, this is market ratio. Okay. Okay, now let me proceed for the first ratio, which is current ratio. Current ratio equals to the current asset divided by the current liability. Okay, let's check it. Check how we provide the answer. Okay, the answer. Current asset. So we need to find the total of the current asset, which is the cash and short-term investment, account receivable, and the inventory. Okay, we total up these three, and we will here, and we divide with the current liability, which is 37481. Okay, so we will get the answer 3.81 times. Okay, for every ratio we need to explain. Okay, for example, I will explain on the first ratio, then you all can try out how to explain. Okay, for the other ratio. Okay. For the first current ratio, we will get 3.81 times. Means that for every RM 3.5 ringgit of company current asset, the company able to repay RM 1 ringgit current liability. Okay, this is how we explain. Okay, Then we will proceed to the IC test quick ratio. Okay, current asset minus inventory divided by the current liability. Okay, let me see how we calculate it. Okay, the current asset, the three, the cash and short-term investment, accounts receivable, and inventory we total up, and then we minus with the inventory back. Okay, so then we will divide with the current liability 37481 million. Okay, so we get 2.37 times. So you all need to explain. Okay, please try it by yourself. Okay, then the third ratio is inventory turnover ratio. Okay, the formula is annual sales divided by the inventory. Okay, let me check. Okay, here 254,553 millions. Okay, we get it at this. Okay, sales, and we divide with the inventory. Okay, here 56372. So we will get the 4.52 times. Okay. Don't forget to explain it. Okay, then the average collection period. Okay, the formula is accounts receivable divided by the annual credit sales and divide with the 365 days. Okay, we need to divide it with the daily credit sales. Okay, so that's here. Okay, we will get 103.06 days. Okay, okay. Then the fixed asset turnover ratio. The formula is sales divided by the net fixed asset. Okay, let me see. Okay, the sales here 254,553 million divided with the net fixed asset. We need to total here. Okay, for the property, plant and equipment 26881, we pass with the long-term investment and other fixed asset. This is the fixed asset, so we total to 0606. Okay, so we will get the answer 5136 times. Okay, remember, explain it. Okay, then the total asset turnover ratio. Okay, the formula is sales divided by the total asset. So here the sales 254,553 we divide with the total asset. Total asset means the current assets and the fixed asset. Okay, let me see the answer. Okay, for the sales to 54553 million divided by the total asset 190,389 million. Okay, yeah. So we'll get the answer 1.34 times. And we will calculate the debt to equity ratio. The formula is long-term debts divided by the stockholder equity. Long-term debt, here, okay, 17895. We divide with the stockholder equity. So here the equity, we just take the formula, the numbers 135013. Okay, see how simple. For the debt to equity ratio, we need to calculate in percentage. Okay, so we need to times with hundreds. Okay, we got 30%. So the ratio is debt ratio. The formula is total debt divided by the total asset. Okay, total debt will, which is the short-term debt plus long-term debt. Okay, the total asset is current asset plus fixed asset. Okay, now we check the answer. Here we go. Okay, here are the total. Okay, total and the total debt. Okay, the current liability and the long-term liability. Okay, current liability also known as a short-term debt. Okay, so the here the under here is current asset and the fixed asset. Okay, all here we get, and we need to, after we get the answer, we need to pass with the with 100. Okay, because we need to get the answer in percentage. So we will get the 29%. Okay, don't forget to explain it. Okay, then the term interest earn ratio. The formula is EB, which is interest before earning and tax divided by the interest expense. Okay, the EB here 35041 divided by 2525 million. Okay, okay, then we will get 30.13.88 times. So okay, then we proceed to the next ratio, earning per share. The formula is net profit after tax minus with preferred dividends, or they also known as net profit available to common stockholder on or sorry, net income available to common stock. And we will divide with the number of common share outstanding. Okay, let's check it out. The answer. Yeah. Okay. The preferred dividend not stated here, so we just take this figure. If have, we need to minus it first. Okay. Then we divide with the number of common share outstanding. Here we take the total. Here, okay, 100,000 units. Okay, then we get the RM 0.18 cents. Okay. Then we need to calculate the dividend per share. Dividend per share, the formula is annual dividend paid to common stock divided by the number of common share outstanding. Okay. Okay. Let me check how we calculate. Okay. Dividend. Okay. This. Okay. 8,000 units. And the number of common share outstanding, as usual, take this 100,000 units. So we get RM 0.08 cents. Okay, then we need to calculate the dividend payout ratio. Formula dividend per share divided by the earning per share. Okay, we have calculated the formula above, so we just need to extract the information, put the answer. Okay, like this 0.08, the dividend per share, then the earning per share 0.18. We need to time it with the hundreds, so we want the answer in percentage. Okay, so we will get 44%. Okay, then the return earning ratio. Okay, the formula is 1 minus with dividend payout ratio. Okay. Okay, dividend payout ratio, if you want to use in this ratio, we need to convert it into point. Okay, 1 minus with 0.44, and we get 0.56. Then we need to convert it again into the percentage. Okay, okay, then the net profit margin, net profit after tax, this after, and this before, and this okay, after tax. Okay, okay, 1854 millions divided by the sales. Okay, the sales here, the sales 254553. So we need to time with hundreds. Okay, so we will get the answer in percentage 7.28%. Now don't forget to explain. Okay, try it by yourself. Okay, then the return on total asset ROA. The formula is net income available to common stock divided by the total asset. Okay, net income available to common stock here 18540 divided by the total asset here 190,389. Okay, then okay, then we need to times with 100. Okay, answer in percentage 9.74%. Okay. Then the last formula, return on equity. The formula net income available to common stockholder divided by the total common equity. Okay, the answer. Sorry. Okay. The net income available to common stock 1854 millions divided by the total common equity. We just did figure 13513 million. Now we need to times with 100, so we get 13.73%. Okay. Don't forget to explain for the current ratio. If the ratio is higher, it's better. But if the lower is the worst, okay? And for the IC ratio, same. Okay, let me check. Okay, I think that's all. Don't forget to explain like this, okay? Sorry. Current asset, the company able to repay every RM3 ringgit Singapore benefit could be able to repay RM1 ringgit current liability. Current, yeah, this. Okay. Okay, like this case, we need to explain. Okay, then good luck and please try how to comment. Okay, that's all. Thank you.